Hi, I'm Tim Kelley from the Montgomery Fund and welcome to this week's Video Insight. Today I want to talk to you about a technique that we use in analysing companies from time to time, and it's one that you may find helpful in your own assessment of individual businesses. And it relates to how you think about the return on equity that a business earns. As many of you will know, return on equity we think is one of the important indicators of the economic well-being of a business. And in thinking about the value of that business, it's good to have a sense of the return on equity that the business may be able to earn on incremental capital deployed over time. So let's just look at an example of a business, and I'll give you just a few years of history, firstly of shareholders' funds. Let's say that we had $100 million in year one, that grew to 115 in year two, then 135, and then 155 million. And let's assume that that business has achieved a return on equity over that period of time of 20% in the first year, 22% in the second year, then 19%, and finally 17%. And if we multiply one by the other, that gets us to the net profit after tax, which on these numbers starts at 20 million, goes to 25, sorry, let's try and get a legible 5, 25.3, then 25.7, and finally 26.4. So these are reasonably healthy ROE numbers. They're certainly above the market average that you might find, and that's a good sign. And we can see that there's been a bit of growth in the profitability of the business over time. But something that's useful to think about when you look at a set of numbers like this is not just the average return on equity, which reflects the full history of the business up until that time. So all of the shareholders' funds that have been invested in the business and the return earned on those shareholders' funds. It's useful sometimes to think about the incremental performance over a more limited period of time. And in this case, if we wanted to look at the incremental performance between this year and that year, what we would see is that there's been an incremental $55 million of equity deployed in the business, and there's been an incremental $6.4 million of NPAT earned. And just looking at those numbers, we can calculate the incremental return on equity, which in this case is 11.6%. And that's a significantly less attractive number than the number that we might have imagined just looking at the average of recent years. And when you see something like this, that raises a question as to whether the economics of this business are deteriorating over time. It may be, for example, a business that has had the opportunity to expand in its market but is now running out of room, and incremental investments are becoming less and less attractive. It may just be that the business has had a more difficult period through here, and we can expect a return to better times ahead. But when you see an incremental return on equity like this that doesn't quite gel with the history, it's always good to think about why that is and whether this more recent period is indicative of what lies ahead, or whether the business may return to achieving these sorts of numbers. That's it for this week. We'll be back with more next week, and in the meantime, you can follow us on Facebook and Twitter.